Now we know that a company is required to produce financial statements. How much money did it make? How much money did it spend? And so on and so forth. These statements act as a useful tool for multiple stakeholders. Number one, for investors. Investors want to see how much profit is the company generating. What were the expenses in this particular quarter like? All these things are extremely crucial bits of information for any investor. Number two, lenders like banks, for seeing how much loans does the company already have and how much would it be possible for them to give to the company. Thirdly, the government as well, for seeing how much tax it can levy on the business income that the company is generating. And similarly, there are multiple other stakeholders which are interested in studying the financial statements of the company. The listed companies which are listed on the stock exchanges we discussed disclose their quarterly results and they are eagerly awaited by the market. The share prices during that period rise or fall drastically based directly on the result of the company that particular quarter. So now we know that the financial statements are extremely important bits of information for the company's management internally as well as for external stakeholders. Okay, let's straight away get into how one of the most important financial statements, the profit and loss account, is prepared. We'll do that via the example of a Vada Pav stall. The first step is that the owner, Mr. Babu Rao, decides to open his stall. His stall's name is borrowed from his own name, Babu Rao Ganpat Rao Apte. Babu Rao collects 1 lakh rupees to start his business. 50,000 comes from his own savings and 50,000 comes as a loan from a friend. That friend has decided to give the loan at 1% interest monthly, or in annual terms, it would be an interest payment of 12%. The owner's capital, or Mr. Babu Rao's own money which he has invested into the business, is called equity, and the amount that the friend has lent to Mr. Babu Rao to start the business is called debt or borrowing of the business. So now the money is arranged. The first thing that Mr. Babu Rao does is that he buys a stall for 50,000 rupees. This, in accounting terms, is called a fixed asset because this stall is going to be used for a very long time. Thereafter, Babu Rao needs money to buy raw material to make his Vada Pav, that is, potatoes, chili, bread, coriander, spices, plates that he'll serve the Vada Pav in, etc. etc. Therefore, he further spends 5,000 rupees to buy everything for the first 30 days that he has to serve his customers. All these things are called the raw material or inventory of the business. After that, he decides that he is going to sell each Vada Pav for 20 rupees. And in the 5,000 rupees worth of inventory, he will make about 600 Vada Pavs. So the total money that he will earn will be 600, that is the number of Vada Pavs, into 20 rupees, which is the price of one Vada Pav. Therefore, the total money that he will earn in these first 30 days would be 12,000 rupees. This 12,000 in accounting terms is called the revenue of the business. This is the first step in the profit and loss account. After this, we have to deduct the cost of making the Vada Pav, which was the 5,000 rupee amount that Mr. Babu Rao had spent in buying all the raw material. The amount which is spent in producing these goods is called the cost of goods sold, or COGS in short. It basically means how much money was spent in just making the Vada Pav. That is one of the most important costs while trying to determine operational efficiency of the business. That at the very core, since it is effectively a food business, how effectively are you making your product and at what price are you selling it? After deducting these 5,000 rupees from the 12,000, we are left with an amount of 7,000 rupees. This term in Shark Tank India you would have definitely heard a lot is called the gross profit. From this gross profit, we will move further down. We know that Mr. Babu Rao will also take some money home as well, right? So he deducts a salary, which broadly amounts to 4,000 rupees for the month. After deducting this 4,000 rupees, we are left with 3,000 rupees. Moreover, the stall that he has purchased will also incur wear and tear. The clients who will come and eat at the stall might end up breaking some parts of it, and therefore that stall will eventually go bad in some time. So Mr. Babu Rao decides that he has to estimate that time after which he will have to purchase a new stall. Okay, so he sits down and assumes that the life of a typical thela or stall is about 50 months, after which he will have to purchase a new one. So, if the value of that particular stall is going on reducing for 50 months, should we take the cost of the whole stall today itself and say that the business has incurred a huge loss because we ended up spending 50,000 rupees and we have only sold Vada Pav of 12,000 rupees? That won't be the case. But why? Referring back to the first lecture for accounting about the principles of accounting. In that we had discussed the second principle, which was the going concern principle, which basically states that you will assume that the business will go on for a really long time. So if you are buying any asset today, which is going to give you a benefit over a long period of time, you can keep on deducting the reduction in the value of that asset as an expense rather than providing for the whole expenditure in one go and saying that the business has entered into a huge loss. Therefore, we slowly, on a monthly basis, we keep reducing the value of that fixed asset over a period of time. In this particular case, the value of the stall is 50,000 rupees and Mr. Babu Rao has assumed that the stall is going to last for about 50 months. So therefore, we will have to deduct 1,000 rupees from that 3,000 to get 2,000 rupees. This 2,000 is Babu Rao's profit, which he has earned before the payment of interest or taxes. From this amount, he has to pay now the interest on the loan that he had taken from his friend. So he pays 500 rupees for the 50,000 rupee loan at 1% interest per month. That would mean 50,000 into 1%, which is 500 rupees. After paying the interest, it leaves Babu Rao with his profit or earnings before tax, which is 1,500 rupees. And the last thing now that we have to deduct from this 15,000 is the taxation. 1,500 in this particular case is called the taxable business income, and after deducting all expenses, cost of material, salary, depreciation on the stall and interest, this is the final income that Babu Rao has to pay a tax on. Normally on this small an income, he won't have to pay a tax, but let's assume the finance minister suddenly wants it and has asked Babu Rao for 10% payment of tax. Therefore, on these 1,500 bucks, he will pay 150 rupees as tax, and after deducting everything, Babu Rao will finally go home with 1,350 rupees in net profit, net of all the expenses he could have incurred in the business. So this was one of the most important financial statements called the profit and loss account, and is the basis of the preparation of the other statements as well. Therefore, understanding the preparation of this particular statement was extremely crucial. That is why we went into a bit more detail. However, we won't be doing that particularly with the other two financial statements because as a lawyer, you mostly just have to view them and not really have to make anything.